Liquidity management is giving European banks a headache under SEPA Instant. Here is how they're tackling it and what we recommend. As a quick reminder, the 100K limit is being removed for SEPA Instant Payments. That means banks need to set a limits on their customer spending. But you can only set a bank-level SEPA Instant Payments limit if you already have one for your SEPA credit transfers. It must match or to be greater than your SCT limit. No matter what you do, you must let your customer set their own daily limit or per transaction limit at the customer level or at the account level. And the change in the limit must be updated immediately across all the payment initiation channels. So, consider your client, Bob the Builder. Bob does business all over Europe. So, he has accounts in every region. If his limit changes in Germany, it needs to be synced instantly in Belgium and Italy too. A centralized limit repository means one update is reflected across all channels instantly. You can learn more by watching our previous video. So, that's all well and good. What's the best architectural approach? Let's first explore 4 ways your colleagues are tackling this challenge. The first is by settling a unified limit. In this scenario, all SEPA credit transfers, instant or otherwise, share the same default limit. This keeps things simple. That said, it's not very flexible, and you must give Bob the option to increase, decrease, or disable the instant transfer limit so that it differs from a non-instant. The second option is to offer a tiered system. It could start with a basic tier, which has a lower daily limit for phone banking, and rise to a premium tier for corporate clients with higher or no daily limit for instant transfers. Here, you must ensure any difference between instant and non-instant tier still meets the instant payment regulation, no less favorable principle. That means you can't charge any more for your SEPA Instant Payments than for your SEPA payment. The third option is to set dynamic limits. This is going to be a win-win situation. So what do we mean by dynamic limits? Real-time risk scoring that adjust or recommended limit levels to your customers based on their history and transaction patterns. Why? Not everyone will set a limit, and you must balance your customer experience with liquidity risk. Let's say you start with a default, a flat cap of 150,000 for everyone, even though you know many will want a higher limit and some will need much lower. Are you providing the best possible experience for your customers? Now, let's say instead you dig into your data, you analyze spending patterns across customers. You find Bob will be happier with 200,000 limit and Grid will do fine with 100,000. In this scenario, not only are you providing a better experience, you are in better position to forecast your liquidity risk. That is, how much money you'd in your instant payments account to cover a spike in your transaction volumes. Your customers can override your recommended limits if they want a higher or lower threshold as long as they pass the authentication. Finally, some banks are allowing their customers to opt out, set the limit to 0 if they don't plan to use instant payments at all. This reduces fraud exposure for those who do not need real-time transfers. If this is the case, it could be an opportunity to educate them on the benefits of instant payments. So, that's the nuts and bolts of it. How do we piece it together? What's the best architectural approach? Single limit check module. First, implement a central component like service or API, which is responsible for storing and enforcing the user's limit. Make sure that both the user interface and the payment processing layer reference the same service. Real-time updates. Make sure any limit changes are reflected in your central repository and then instantly enabled for every payment channel. This satisfies the requirement that user must be able to lift or modify the limits anytime without difficulty. Synchronized display of limits. Every payment channel, no matter it is web, mobile, branch, must check the central repository before initiating a transaction to display the up-to-date limit. This prevents confusion, for example, where one channel displays an out-of-date limit. And finally, a payment processing integration. When a payment is being made, the central module should check the available balance and the customer's or account level instant payments limit. If the transaction exceeds the limit, the request should be immediately declined and the payment cannot be processed. This is consistent with the IPR's real-time nature. So, limit management is a core compliance and customer experience topic. It's an opportunity to stand out, focus on the details, make it customer experience to remember. If you're struggling with SEPA Instant, speak to RedCompass Labs. We have been helping banks of all shapes and size get ready for the instant payment regulation. We are always happy to help.